Okay, and then the content structure of this module 2 is firstly on slides 3 to 4 we focus on what is a price ladder. Then we just look into the history of the price ladder on slide 5, and slide 6 the interpretation and the meaning of a price action. Slide 7 how to use a price ladder. Slide 8 the benefits of trading on the price ladder, and this is really rather important for those of you who don't trade on the price ladder. Then slide 9 building your workspace, and the various workspaces we use as traders and how we set up our workspace, whether we're trading various central banks or just our core intraday markets. Slide 10 rather exciting, some interviews with some of our tops Axia traders. And then slide 11, it's an advanced order and execution types. Slide 12, we look at the price ladder and trading lingo. Some of you who will be watching our live stream and the live floor trading experience, when you overhear our traders talking about specific plays and patterns, it'll just make you understand the various lingo that they're talking about. And then slide 13, we're just quickly training you on trading coordination drills, so you really maneuver very quickly on the ladder. What is a price ladder? I want you all to bring up your ladder charts like you were shown in the how-to section at the introduction of the course, and bring it all up so you're really engaging in your learning in real time as we explain really the anatomy of the price ladder. Now, there's a really great definition on this link, so please click on this link, and when you click on this link it'll just give you a more detailed description without me having to really go through it before I go through the anatomy. So go ahead, put a pause on this video and click that link and just read through it so you understand whilst you're looking at your price ladder, so you consolidate your learning from that perspective. Now, there are other common names used synonymously with the price ladder that you might hear in the marketplace, or when you search on Google or so forth, or you hear traders speaking about. Is the depth of market, the DOM, also the order book, and market depth. So those are really the key synonymous names for a price ladder. So now we're really going to go looking at the specific components that make up a price ladder. So please ensure that you do have your price ladder up, because as I go through each of these elements, you're able to look at it on your live ladder in real time on your TT ladder environment. So firstly, let's have a look at where the bids are. So on the left hand side, or the blue column, are all the bids. The bids, as you can see on the prices on the left, that represents all the buy orders. Then next you have your price column, and that's the gray area. It's the price of specific market that you'll be any specific market that you're looking at. Then next we have the offers or the asks, and that is the red column, and where the bids and the offers meet is the currently traded price. Next we have the high of day, and the current high of day is 3095 as per the slide, and that high of day is indicated by the yellow line at the top, where it goes from dark gray to light gray. So that's the high of the day of the market. Next we have the low of day, which is at 3066, and that's indicated by the red line, which separates the gray pricing box area to the light gray price boxing area. Then next we have the volume profile as indicated by the blue histograms that are lying on their side. So it just shows you how much volume has been traded relative to the entire day. You have not only the blue histogram, but you actually also have the number that's being traded at that price. Next you have so if you were to see the actual size, so for example at the price of 3079 we have 1607 lots. So that 1607 lots could represent one person with all that size, or a whole host of different people. Unless you have level 3 data, this is 2 levels of data. Unless you have level 3 data, you don't quite know what that 1607 lots is comprised of. But at that price, at 3079, we have 1607 lots, and that dynamically changes, every split second, every second, and so forth. So that is how you, and that's on the offer. So that, because this is the red side, this is on the offer side. Next we have at the 3069. We have 3,003 lots on the bid at 3069, and that's the current bid. That if you wanted to sell the market, if you wanted to offer the market, you could sell up to the amount of 3,003 lots at that specific point in time at 3069. Next, we have 6 lots of accumulation of the last trade. Now that white highlighted box where it says 6 lots, that's the cumulative lots of trade at that current price. Provided the market consistently trades at that price, which is the last trade, that number shall increase. Now, if the market were to trade the offer, if the market were to lift the offer, then it would first go green on your TT platform. So it would first highlight green, and then once it continuously trades, so the first lot that goes through, or the first lots that go through, or the first clip that goes through, that will highlight green, and then every clip thereafter, provided it's still trading at that price, will then be accumulated price, and the color will change to white. And the converse is true, except if the bid is hit, then it's going to go red in the first instance of whatever size that was hit first on the bid, and then when the bid has been hit, and then when the bid is hit furthermore after that initial hit, then it'll change the color of white, and that is be the cumulative last trade. So now let's just look into the history of the price ladder. Well, it all started on the trading floor, really. It went from the evolution from the trading pit to the electronic screen. So if any of you have seen those movies or those classics in the 80s and the 90s where you see all these guys shouting and being crazy, buying this and selling that, and this whole cauldron of activity and energy, well, that's where trading was. But it was a very archaic model because, you know, orders being filled, relying on somebody else, meeting your order or meeting your sell order. Well, that's really changed since we went electronic, especially in the back end of the 90s, especially within the price ladder future space that we trade. Now, if you want to look at a timeline of events, click on that link, and it just elaborates a little bit more about the entire sequence of events. It really goes back to around the 60s till our present day, when electronic trading started becoming really made trading a lot more efficient, and order filling a lot more efficient, and a lot more of a so-called level playing field, where access to the markets is accessible to everyone in the world. So if you want to have any more details, then just click on that link on your slide, and further in understanding investigation with regards to the whole timeline and sequence of events. And there's a couple of links there for you. Now, what is level 1, 2, and 3? Now, we spoke about it a little bit in the previous slide. Level 1 is really what's just currently being traded, and the current price that you're being shown by the broker. Level 2 shows you the entire depth of market and how much is willing to be traded at each price, and seeing the buy and sell orders along a certain depth of the market. And trading technologies, the depth is between 10 to 20 prices. So at each single price, you can see the buy and the sell orders, whereas on other spread betting platforms or so forth, you only see one level of data. And for us as futures traders, that provides us no information. It doesn't show us potential patterns or underlying intention of the buyers or sellers or sellers in the market. Level 3 data there, it actually shows you at each buy and sell price along the whole depth of the market. You can actually see what each one of those total orders are comprised of. Is it comprised of one buyer or one seller, or a whole collection, and how many buyers or sellers are at that price? That's level 3 data, which you can pay the exchanges to receive that data, but most futures price ladder traders just operate on level 2 data, and the course is geared around level 2 data. Now, the price ladder advantages level 2 data, as you'll see throughout the entire course, it really shows the level of interaction and prices. And therefore, when you can see the level of interaction and you see the buys and the sell orders and the activity and the intent of the orders going through the market and the speed that they go through, this gives you so much information on the directional bias that the market could start going. Or if we're breaking a certain level in the oil market, in the gold market, in the S&P 500, when we're breaking that level, but you're seeing on the price ladder there isn't that real intention, well, then there's a greater chance that there's a potential false break play on the on the hand. But you can't see that on charts. You can see that on the ladder. You can see from the lack of follow through, or the lack of really, or the lethargic nature of when you're watching level 2 data. So that's really the core advantage of price level 2 data. There's another link there for you to click, just for you to understand the various market levels of data. And then finally, just some more, just more explanation. So from this slide, if you really want to gain a deep understanding, if you're a novice, I really strongly suggest research and read up on all those links that I provided for you guys on the slide, so you get a real deep understanding and deep grounding in really the advantages of a price ladder. Okay, the interpretation and meaning of a price action. What is price action? Well, for me, I have a specific definition for price action. It's what we use on all of our trading floors across the world, and it's the personality of the market's level of exchange. So what is that personality? And to me, that personality is how aggressive, how quickly are the orders going through the order book. Is it at 20 orders per second, 100 orders per second? And it's your eyes' ability over time to really work out that level of intent, that level of acceleration. And as you're watching your ladder during this introductory module, and your ladder should all be loaded up on your screen, is seeing the orders going through all the order book. When the orders go white to green to red on the or the cumulative orders that are going through, is how quickly are they going through, or how slowly are they going through, and how are the orders when the orders are going through the market, how are the actual orders, the static orders that are consistently changing, how are they interacting with what's being traded in the market, and how is their personality altering. And although this seems rather the description is at this time seems perhaps for some of you a little bit confusing, as we go through all the examples and the real trading examples, you'll quickly be able to see the new patterns that really emanate from the speed and the acceleration, and how we like to describe it, the actual personality of the market. And really, from the personality, a whole bunch of price action patterns start coming out of the market. So if the market is going through, if the exchange on the order book is going through rather aggressively, well then at a key technical level, well then you're going to have a particular type of order flow pattern that you want to execute, and a particular type of price ladder action pattern that you'll be looking at. And then what are the recurring events that have associated trading strategies to profit from? So, as you consistently watch the ladder day in, day out, and watching the price personality and how fast the orders are going through the order book, or how slow they're going through the order book, then what will emanate from the marketplace are different types of order book events. And an order book event or a price ladder pattern is just a recurring pattern that has occurred in the past, and therefore you having the ability to execute a certain type of trading strategy in order to profit from. And really, so it's order flow. So the order flow, how we describe order flow, is what's being exchanged on the book. So whilst you're looking at your ladder now, and when you see that white box accumulating, or you see that green box, when that green box appears, the red box, how quickly is it doing? And that is the order flow. That is the order flow, the real crux of the marketplace. And how, as the orders are going through the market, do the orders on the red column and the blue column, so the bids and the asks, What are they doing? Are they at the current traded price? Are they disappearing, or are they remaining static and building up? And how are they actually interacting with the trades that are going through the market? And this is critical level 2 data that you're looking at. And in order from that level 2 data and those observations to a whole universe of price ladder patterns are really spawned, so you can interact, engage with, and trade to profit from. And really a similar type of concept and the same interpretation is what you call order book events. And an order book event is, given that the order book is really thinned out, and prior to a key data point, you know that the moment the order book has become thin, so if on average the buys and the sells are 300 lots at each price. The average lot size on each price is 300 lots, 300 lots, whilst you're looking at your ladder here. And all of a sudden, they go down to 20 lots, 20 lots, 20 lots prior to an event. You know that event is a key market event that the market is looking at, simply because the market is reducing its risk, and people are taking risk off the table and disappearing the orders from the order book, and that therefore can create a volatile order book event because you've observed that pattern in the past. And then the market environment that governs certain order book patterns. So, for example, as we look at the other modules down the course, when the market has a lot of activity, when the volume is the traded volume is going through the market very aggressively, very fast, well then in those types of conditions you're more prone to potential breakout trades, or it's easier to see absorption plays. And these words that I'm using now, you won't understand them now, but they'll be a lot more clearer when we go to those specific sections of the course. But the picture I'm trying to paint here is that there's an entire personality to what you see, what's going on in the price ladder, and the level of intent can therefore really help you put forth a really strong trading strategy and trading plan to profit from the personality or the acceleration or non-acceleration that's going through on the price ladder.
The TT platform gives users the ability to customize their trade execution with TT algos. TT algos are synthetic order types that provide functionality beyond what is natively supported by many exchanges. With TT algos, you can trigger orders when certain conditions are met and reduce the impact of your orders on the market. You can trigger orders on price action, slice orders into smaller increments, submit or cancel orders based on the fills of other orders, and more. TT algos are accessible from the order ticket using the order type dropdown, as well as from MD Trader through the order pane. At the top of the order type list, we see our standard order types supported by the exchange for the selected instrument. Beneath, we have our TT algos. We'd like to place an order to buy 200 Euro Stoxx futures on Eurex, but we don't want to disclose our entire order. Eurex does not natively support an iceberg order type, but with TT algos, we can select the TT iceberg. Clicking our desired algo displays a flyout menu where we can enter our parameters. For our TT iceberg order, let's submit our order in increments of 25 at a time by setting the display to 25. When finished, we close our flyout menu. If we want to change our settings, we simply click Edit. With our algo selected, we can place our TT iceberg order by clicking on the desired price level in MD Trader. We see in our order book that TT algos consist of parent and child orders. The parent order is the synthetic order that resides on the algo server and can submit either single or multiple child orders. Child orders are the native orders that are actually placed on the exchange. In our parent order, we see our order type of TT iceberg, our order quantity of 200, our working quantity of 25, and our undisclosed quantity of 175. We can see our child order is a 25 lot limit order. Once our first 25 fill, the parent order will submit another child order of 25 into the market, and so on until the total order quantity of 200 is filled. For TT algos that we use frequently, we can create custom order type buttons in MD Trader. We right-click in our MD Trader to access the settings menu and can then select order type buttons. We click the green Add icon and open the drop-down menu to view the list of order types and TT algos. Let's select our TT iceberg algo. We'll shorten the label for our custom order type button to IB. We can see a preview of the button to the right. When finished, we click OK. We would like this button to appear on all future MD Trader widgets, so we're going to select Set as Global Defaults. To make our button available, we click Apply and then Save. As you can see, we now have our TT iceberg button in our MD Trader order pane. When we click this button, we are provided the TT Iceberg Algo order parameters. Let's again set our display to 25. Our custom order button is highlighted yellow, indicating that this algo order type is active and ready to be placed in the market. For more information on the algos available through TT, visit our website at tradingtechnologies.com. TT Algos give users the ability to improve their order execution by automating the placement of orders based on various criteria. With the TT Bracket Algo, traders can mitigate risk by placing an order and automating their exit strategy by the triggering of an OCO once the initial order is filled. The OCO consists of a limit order to realize a profit and a stop-loss order to limit the loss on the position. Let's use the TT Bracket Algo to enter a long position of 10 E-mini S&P futures contracts and set our profit and loss parameters. We select TT Bracket from the Order Type drop-down menu in MD Trader. We are going to set a profit target of 8 ticks to submit a limit order 8 ticks away from our initial fill. We will set a stop-loss of 4 ticks to trigger a stop limit order 4 ticks through our fill price. We want our stop order to be entered at this trigger price, so we are going to set pay up to 0. After setting our order quantity to 10, we will join the bid by placing a limit buy order at 2154.25. Once this order fills, TT Algos submits an OCO order consisting of a limit order at 2156.25, 8 ticks above our fill price, and a stop limit order at 2153.25, 4 ticks below our fill price. We see our limit order fill at 2156.25, exiting our position and meeting our profit target. The TT OCO parent order then automatically cancels the stop limit order. As you can see, the TT Bracket Algo makes it easy to automate an exit strategy following the execution of an order. TT Bracket Algos can be launched from an order ticket as well as MD Trader. Users can set a start time and an end time on the entire algo and can also have the algo triggered by price action. For more information on TT Bracket Algos, visit our website at tradingtechnologies.com. The TT OCO order type lets traders enter 2 orders that are linked together. One of the orders is a limit order away from the market, and the other order is a stop order. If one of the orders is filled, the other order is automatically canceled. Traders typically use the TT OCO to automate their exit strategy from an open position. The limit order is used to realize a profit at a predetermined level, and the stop order is used to limit the loss on the downside. Currently, we have an open short position of 5 E-mini NASDAQ futures contracts. Let's use MD Trader to enter a TT OCO to close our position. From MD Trader, we select TT OCO from our order type drop-down menu. We are going to use a stop limit order for our stop and set pay up ticks to 0. With our parameters set, we need to select the price levels where our limit order and stop limit order will be placed. Though they can be placed in either order, we will first submit our limit order. We can see that the price level where this limit order will be placed is now highlighted. The order is not entered until the stop order portion of the OCO is placed. As we go to select the price level for our stop limit order, we can see that our mouse pointer provides a visual indicator to indicate where our stop order can be placed. MD Trader prevents us from placing this stop on the wrong side of the market and displays a no symbol whenever the mouse pointer is at an invalid price level for the stop. If the mouse pointer is at a valid price, our pointer becomes yellow and the letters SL appear, and we can place our stop limit order. Once we select the price limit for our stop limit order, the TT OCO parent order submits child orders and begins working both the limit order and the stop limit order. When we hover over either of the OCO's working child orders, we see both are highlighted to indicate that they are linked. You can cancel or modify the price of each order independently by simply dragging and dropping. Once our limit order is filled, the TT OCO automatically cancels the stop limit order. We can also enter a TT OCO order from the floating order ticket. Here we have a market grid displaying several contracts. We have an open short position of 10 E-mini Dow futures contracts. We can click on the position to launch our floating order ticket with the quantity field populated with the size of our position. We select TT OCO from the order type drop-down menu and set our stop order type as stop market. With TT OCO selected, we are provided a new field in which to enter the trigger price for the stop order. Let's enter the desired trigger price for our stop order here. Finally, let's enter the price for our limit order and click Buy to enter our OCO order. We can see our working orders in MD Trader as well as in our order book. Our limit order at 18,368 and our stop trigger order at 18,380. Once the market trades at 18,368 and fills our order, the TT OCO automatically cancels the stop order. TT OCO makes it easy to automate an exit strategy by working both a limit order and a stop order and automatically canceling one order when the other fills. For more information, visit our website at tradingtechnologies.com. TT provides a number of TT algos for breaking larger orders into multiple smaller orders. The TT time-sliced order slices a large order quantity into smaller disclosed orders and sends each into the market at fixed time intervals, which can be defined as a number of minutes, seconds, or milliseconds. It can also be configured to begin placing orders at a specific time, as well as once a chosen price level is traded. If we'd like to buy 50 S&P futures contracts without disclosing our full order quantity at once, we could use TT time slice to help minimize our impact on the market. We select TT time slice from the order type drop-down menu. We'll have the time-sliced algos submit a limit order into the market every 3 seconds and display 5 contracts at a time. We want these limit orders to join the bids, so we will set an offset of 0 from the bid. We can customize the behavior of orders still working in the market when the next order is submitted by defining a leftover action. Should the previous 5-lot order not be filled at the end of the time increment, we will set the leftover action to pay up and set a number of pay up ticks to 1. This will adjust the price of the previous working child order by 1 tick. With TT time sliced, we can have our algo begin submitting child orders on a specific event by checking Trigger. Let's configure our algo to trigger once our last traded price reaches $20.7950 by setting our trigger to If Touched and set a trigger price of $20.7950. This will hold the algo on the TT server until the market trades at that price, and then TT will automatically begin working the algo and submit the first child order into the market. We place our 50-lot order and can see the parent order in the order book and audit trail with our trigger price at $20.7950. Once the market trades at our trigger price, TT begins working our algo and starts joining the bid with a 5-lot order every 3 seconds. We can see that when one of the order does not fill at $20.7925, it is paid up 1 tick to $20.7950. The subsequent order then joins the bid also at $20.7950. The TT time-sliced algo continues to submit orders until the whole 50-lot order is filled. As you can see, breaking your larger order into smaller quantities with TT time-sliced gives you the flexibility to time the submission of these orders by minutes, seconds, or milliseconds, to trigger your order once a specific price is traded, and customize the behavior of child orders. For more information on TT algos, visit our website at tradingtechnologies.com. TT provides a suite of TT algos that enable traders to customize their order execution. With TT Stop, you can define a number of ticks at which to trail the market, offset the submission of your order a number of ticks once triggered, define the time in force, and more. If we had an open long position of 5 contracts in the E-mini S&P and wanted to enter a stop order to exit our position, instead of using a native exchange stop order, we can use a TT Stop to customize the behavior. When we select TT Stop from the list of order types, we see a flyout menu where we can enter our parameters. For our TT Stop order, let's trail the market by 3 ticks from the last traded price, and when triggered, submit a limit order. We can apply a positive or negative offset, which will place our order the specified number of ticks away from the inside market. With this stop order, we want to send a limit order 1 tick beyond the trigger price, so we will set the offset to -1. We place our order and can see the parent order 3 ticks from the last traded price in our MD Trader, with both the audit log and order book displaying the trigger price. As the market rallies, our sell stop moves up, trailing the last traded price by 3 ticks. When the market comes back down and trades at our trigger price, a child limit order is submitted to the exchange 1 tick beyond the last traded price, which fills almost immediately. As you can see, TT Stop gives you the flexibility to customize the behavior of your stop orders, such as triggering your order off of last traded price, bid, or ask, the ability to trail the market, as well as providing traders the option to set a customized time in force. For more information on TT algos, visit our website at tradingtechnologies.com.
Okay, so now let's look at how to use the price ladder. Now, the next couple of videos, we're just going to be focusing exclusively of how to change your orders, how to manage your orders, how to enter OCOs, icebergs, and all the different order types. And I want you to actually put on 300 trades within the space of an entire day using different types of order types, and really experiment, when there's one that you don't quite understand how to execute. And the whole purpose of the exercise is really to understand the different types of orders and how you're going to execute them. So importantly, we're going to be looking at executing orders, a simple approach in the videos, look at passive versus aggressive market orders. Now, a passive order is normally when you just not going in at market, so you just put a order entry waiting to be filled either on the buy side or either on the sell side. We also look at stop and limit orders, and so as you enter the trade, how to where you'll put your not where you'll put your stop, but at whatever level you want to put a stop, how to actually execute that on the Trading Technologies platform, and as well as limit orders. And then we also look at OCOs, which is order cancel orders, and you'll really get a very firm understanding of how to execute orders, as well as the various different trading stop orders. So please look at detail of all the videos. They're all been compiled by Trading Technologies, so I really want you to play with them on your platform. Okay, the benefits of trading on a price ladder. Now, those of you who are used to just executing with one level of data, where you just see how you can execute on the buy or the sell side, or waiting to deal a ticket or have an order ticket on your traditional spread betting platforms, an exercise that I want you to do is actually go and open up your price ladder and open up a market ladder. And I want you to put one lot on the price ladder and use that exact same size that you would be using in on a spread betting platform, and whatever, pick whatever spread betting platform you want to use, and whether that spread betting platform is a current one that you use at the moment. I want you really to see that when you enter at market, because the price ladder is connected to directly with the exchanges and you have direct market access, you have to work out the mathematics of effectively every single time you go in a market and you get the best price. Whereas opposed to when there's a spread on any of these spread betting platforms, if you now count that over a week, over a month, over a year, over 2 years, and you multiply that spread out every single day, especially if you trade more than once, twice a day, you start trading 10, 20, 30 times a day, like a proprietary trader does, such as ourselves at Axia Futures. Guys put on between 30 to 100, 150 trades in a day. It makes financial sense. Not only financial sense, just but the speed of execution. Some of our best traders trade geopolitical events and breaking comments, and they organize their news desk in such a way that the moment that news is released, they're able to execute on their ladder in the most efficient and the quickest manner. And to be able to execute and get the best price is critical, because if you're doing that with really large leverage, well, then it really matters of what price you get, and you want to be getting the best price and the fastest way, and you want to be getting that price with the best latency. And that's why all these now new ways of connecting to the exchanges, you have to ask, does your spread betting platform connect directly to the exchanges? Is there a pipeline that connects directly to the exchanges? Is your brokerage actually have servers at the exchanges? And that's what we have with the platform, with Trading Technologies, is it's co-located effectively, so all the servers are at the exchanges, so you're always getting the best price. So it's so important of ensuring, and I really want you to make sure that you do that test and work it out for yourself. I'm not a salesman for Trading Technologies or any other price ladder platform. So whichever price ladder platform you use, just always ask yourself the question, do they have servers that are connected to exchanges, and does your IP address of the exchange that you're trading connected straight to exchanges? Because if it's not, you always, that split little second delay when you hear that breaking news coming through your news wire, or the squawk, or when ECB's Draghi says there's going to be an emergency rate cut or an emergency rate hike, or when the UK is about to vote against a Brexit through the UK government, then you want to make sure you get that best price. And the best platform is always to make sure it's a price ladder platform that's direct market access, that also is located at the servers, and you have the IP linked directly to it. So really, as I've just summarized here, it's the execution differentials and the mathematics of the trade that makes sense if you are an intraday trader. If you're a longer term swing trader, it doesn't matter that much, but it depends how much leverage you'll be executing. Just remember, the price ladder is the first derivative of the market. It's the raw price action, so you have direct market access. Everything else, whether it be a spread, the chart, you execute on the chart, you're not getting the real information. Just also understand that charts are second derivative. The order book is really the purest form of the market, and you have a direct market access, as we have been mentioning. Building your workspace. Now, this is so critically important for every single professional trader. it's your workspace that you're going to optimize your information gathering when you're trading a specific core market, and understanding which are the most correlated markets to your core market, or which markets are in theme that are going to affect your market, and making sure that wherever your core market is located on the screen, that you have within striking vicinity the markets that are going to affect that market. So effectively, it's really important, as we've mentioned on the bullet point over here, depending on your core market will determine how to optimize your workspace. And you need to have your normal trading workspace when, for example, there's no core macro or geopolitical theme running through the market, or when you, and that's critical. So you just have the balance of your workspace. Now, the next thing is having your special events workspace. So when you have an ECB meeting, you're going to make sure that you're going to have all the bonds in the European space first. Your German bonds, your B2Bs, your OATs. So you have your B2Bs being the Italian bonds, your German bonds being Bund, Bubble, Schatz, the entire curve, as well as having the French bonds, and then the equity indices in Europe that will be affected, such as your equity indices, the Euro stocks, and the DAX, the core ones, and then having your currencies, the Euro USD, all very important, and having the liquid markets. And now if you have a particular event going on through the world, when we had the subprime crisis affecting credit, then you want to have the short-end stir markets, because that's those are the markets that are moving when the credit conditions were unraveling. So really critically important to understand not only your themes, but therefore how to design your workspace. And what we'll be looking at in the next couple of videos after this slide is building some specific workspaces for when you're having normal trading conditions, and we'll be looking at workspaces for the ECB, the Fed, and the BOE. And then again, when we have these firm geopolitical events, also how do you build your geopolitical workspace in order to extract the most information from your trading? And as always, as you optimize your working space, you increase your peripheral awareness. And what that means is you'll notice at the beginning, when you're watching one ladder, it's very difficult to observe what's happening in other markets. But the more, with anything, your brain starts building that unconscious map in front of you, and over time you'll start realizing you're able to observe and notice moves right on the other side of your screen. For example, there's a potential bomb in France, and you see the OATs moving aggressively quickly, or the Euro stocks, that'll affect the treasury curve. So really important is over time, through deliberate practice, you really start increasing your ability for your peripheral awareness across all the markets. Okay, welcome to how to optimally design your price ladder workspace. Now, this is really critically important for extracting the most information in a particular market or your core market that you're trading. And what we're going to look at this video is we're going to be looking at how to design your everyday, day in, day out core price ladder workspace. And really it's how to optimize your real estate, your desktop real estate that you have, in order to extract the most information from a particular market that you are focusing, or a particular couple of markets that you are focusing. Some traders trade up to 8 markets. A lot of the very large intraday traders and very large and specific markets only focus on 1 or 2 markets. And some guys who trade in 100 lots to up to a couple of thousand generally just focus on one market. So the video is going to be looking at the core market. Then we're going to be looking at how to set up your workspace for trading central banks and the central bank events. And then we're going to briefly speak about how to design your price ladder workspace given the theme that's running through the market, or the geopolitical themes that are running through the market, such as when the financial crisis and the subprime crisis was happening, or the European crisis. And that's what we're going to be looking at in this video, for you to see how you will design your own personal workspace. Remember, this is just a template. You can design from there, and as you develop as a price ladder trader, you'll start just making and tailor making it towards yourself more ideally. So let's now have a look. So I actually trade the European German bond curve. So with trading the European German bond curve, well, I've got over here in this screen, I've got the Bund market. So this is really my main market that I trade, as you can see. And I've got it really nice and big, really bold, so I can see the bids and the offers clearly and the price clearly. And I can see the volume profile along the ladder, as well as seeing how much has been trading at each price. So all very important. And then I have my time and sales, and because this is late in the evening on a Friday night, we've only had one order of above 50 lots, so I actually have my minimum order size of 50 lots. If I were to change that at the moment, so if I were to change that and make it 0, you would see the orders come through. So as 7 lots goes through, you've seen that 7 come through. So the next order that we see come into the market, and maybe it depends how long we have to wait, as it is a Friday night and the market's not trading with great. So there, 20 lot, you can see it's just gone through, and a whole bunch of different orders just went through now. So 20 lots went through at 161.10, another 1 lot now at 161.09. So this is my core market, the Bund. And now next to the Bund, now the most important part is how do you extract information from markets that are very closely correlated. So what I do is I make sure the correlated markets that are effectively going to affect my main market will be in very close striking vicinity. So what I have over here, I have the German 5-year, so that's the Bobl contract. So I've got the 10-year German paper. It's the interest rate market. You'll know if you do our Zero to Hero course, our introductory course, you'll understand what the interest rate markets are. And so over here I have then the 2-year paper. It's called the Schatz. So I have the 10-year, the 5-year, the 2-year, and I don't have the 30-year now because I don't actually look at it too much, except if we have some really big curve plays, but that's beyond the scope of this video. And then next to the Bund, I have the main equity index of Europe, equity futures index, which is the Euro Stoxx, also one of my core markets that I also trade. So you can have the Euro Stoxx. So if we have a theme where there's a broad risk on or risk off theme, you generally see the Euro Stoxx, or if it's a risk on, bidding up, and the bonds selling off as there's a risk on or a lack of flight to safety. Then I have the Treasury market. Now the Treasury market is the global benchmark really for government bonds. So I have that right over here, and I have the 10-year market, the 5-year market, and the 2-year market. So the 10, 5, 2s, just like the German, the 10s, 5s, 2. So I can start seeing how they're reacting to each other. If I see a very big move in the Treasury market, then I expect a move to start happening on the Bund. There are very strong algorithms and arbitrage algorithms out there. So normally, as the T-note reacts, so will the Bund. But sometimes you get delay, or sometimes the T-note is going up, and then there's someone sitting on the offer or a potential iceberg, which we look at later on in the module, and someone keeps on selling, which means that there's a potential spread going on between the two markets. So again, the 2, 5-year, and 10-year of the German curve, and then the European curve, of the US curve. Then what I have are the 10 years of the French market, what's called the OATs, and over here the Italian market, the BTPs. So already, as you can see in this picture, I've got my main bond markets in, so my core market being Germany, then the US, then the Italian 10-year and the French 10-year, because those, as markets orders go through in those markets, they can influence my market. So I just want to have that awareness of markets that are most closely correlated to mine. I have them in very striking vicinity. And then I have my Euro Stoxx index, and then I have my Euro USD. Remember, so I'm trading European products. Because I'm trading European products, I want to have to be able to see what the dollar is doing, but more specifically what the euro is doing in the financial space. And then I have one of the main equity indices of the world, the American. I always have on all my platform, I'll always have a US equity index, and the main one being the E-mini S&P 500 futures. And then to get a broad understanding of what's happening in the dollar space, I have cable, which is 6B, I have the yen, and I have the Canadian dollar and the Australian dollar. So these are your so-called commodity currencies to see what's happening if you're seeing a broad move in the commodity space. And you can extend this beyond, and also have gold and oil. I don't have it on my Pacific chart. I don't trade those markets as often, but this is generally my setup. And the most important, you'll notice, when you look at the setup, you think, oh, well, it all looks very confusing. But the human brain is incredible, and the human brain over a period of time starts putting all of this into really one picture, and you'll notice quite quickly how your peripheral awareness really starts picking up. You'll notice a little move in the shats, or the shats going offered as there's a potential repo market unraveling, or short-term debt collateral in Germany is being affected, and you start seeing, a move in the Bund. All of a sudden, you start seeing a spike up in the Japanese yen, and as a result, that spike up in the Japanese yen, so the yen is strengthening, and if the yen is strengthening, you will potentially get if it's a yen that's strengthening against all the other currencies, then all of a sudden you might get the Euro stocks weakening, and therefore you have a potential risk-off play, and then you'll see the bonds start going up. So you start picking up all of these little patterns. All of a sudden, there's a big speaker out of the USA, such as Fed's Dudley or Yellen, and they say something that will affect the Treasury market, that they'll raise rates next month. You'll see a big offer in the 5-year paper, and the 2-year paper, and the 10-year paper. And as a result of that, I've noticed this big move. As a result of those comments, I can get on a short in my main core market. So this is how I set up a core market, being when I'm trading the interest rate market. Now, if you were trading the Euro stocks as your exclusive core market, then you'd have your Euro stocks over here as the main page. You'll have the S&P 500 right next to it, as it has a strong correlation. When the US global equity markets move, they cause a ripple effect around the world. And then you can have the DAX next to the Euro stocks, because the DAX and Euro stocks should move more or less in sync. And then you can have your bond markets and your currencies like I've set it up. So depending on what your core market is will determine how you set up your main area. But this is for setting up if you're trading the European bonds market. If you're trading the Treasury market, well, you might actually have here, if you're trading the 10-year paper, you'll have the 10-year as your main market over here. And then you'll have the 5-year and 2-year and the 30-year perhaps. And then you might have the Euro-dollar curve, which is a short-term interest rate market out of the US that's really priced along the Fed funds rate, and then which we'll be looking when we set up our FOMC space. But that really just gives you an image of how you can manipulate according to your core market. But the most important consideration, really the most important consideration, is whatever your core market is, just make sure that you have the markets that are most correlated to your core market that will affect movement. And as you gain more experience in the markets, you'll know exactly how to optimize and set this up. And this is just a really basic introduction to setting up your workspace if you're trading the European German bond market. Now let's start clearing this all up, and now let's look as if you were trading a central bank event. And just to let you know, for trading the ECB, so the European Central Bank, I would pretty much have exactly the same template as I have over here, because I get all my information. If the ECB move on rates, I'm going to get moves in the 2-year paper, the 5-year paper, the 10-year paper. But what I might add is I might actually add over here the Euribor, which is the European short-term interest rate market. So I might add the December. So we now, in the moment, we started December 2016. So we might have over here the Euribor curve starting, from every 6 months or every year, just so you can see how the curve is affected by the ECB. So that's the one difference I'd have on this page. I still have all the European bond markets, the euro dollar, very important, and I might take away I'll take away the ZN, so the Treasury market. So we'll take away these over here, and what I would do is I would then include over here the Euribor short-term interest. So therefore, when I'm trading the European Central Bank, I'm very well prepared for trading that market and getting the most bang for buck information, because the interest rate from the central banks can affect the entire European bond market as well as the equity market, and you want that as your main source for when you're trading the ECB central bank. Okay, so now let's have a look at if we were to trade the FOMC central bank, and you'll use the same type of common template like I've just explained over here. So let's just look. I've just got another workspace over here. This is actually a demo workspace. So let's just have a look right here. And so how I've prepared this, if you're trading the FOMC, which is the Federal Reserve Bank, of the USA. So how you would set this up is, if you're trading, generally the most sensitive markets are going to be the interest rate markets in the USA. So the markets that you would have up, I would have whatever your core market that you're going to be trading on the day of the FOMC. You have a chair and you elongate the market. So you elongate it so you can see what's going on the book, and if the market moves around. And what I'd have here is, this is the 10-year market. Then I have the 30-year market over here, the 2-year market, the 2-year treasury, and the 5-year treasury. So 2, 5, 10, 30. So I see the entire curve and how the various parts of the curve are affected. So for example, if they come out and they surprisingly increase interest rates, you'll get the 2-year moving the most, followed by the rest of the curve, as the 2-year is the most sensitive to moving interest rates. But this is what we discuss in the other course. We're just showing you how to set up your price ladder space. Then what I'll also have is, I'll have the short-term interest rate market. So I'll start with the December 2016, so the nearest month. And then I'll move another 3 more months later, and then I go for every DEC contract, DEC 18 up until DEC 19. So effectively going 2 years out on the short-term interest rate market, because these will be highly sensitive to surprise rate moves. And when you see the way this curve moves, how this curve moves will effectively have the influence how this curve moves over here between the longer dated papers, such as your 2-year, your 5-year, your 10-year. And this is how you want to set it up really for the FOMC. And then this is what we've just done here. We've just looked at how we'll set up the interest rate market, and then I'll have the American equity market. So if we look over here, I'll have the S&P 500 index right here to see how that's influenced by the FOMC and the rate decision. And then I'll have the euro dollar, so a currency. I'm just using one currency here, so I can get a broad picture of how this is affecting all the asset classes from the FOMC rate decision. And then I'll have 2 commodity markets. I'll have gold, and I'll also have crude oil. Now the reason why we have these is because sometimes one of the asset classes actually moves quicker and moves truer compared to the other ones. And gold has been known for the last year to really move first in the direction of the rate announcement. And if the market doesn't like what it's heard from the FOMC and decides to reverse, the gold is generally known to reverse first, and then all the other asset classes start following. But this is what the little patterns that you pick up over time, and these little nuances that you'll develop. So this is how you'd set up your FOMC paper. This nice squiggly bit of painting that I've created over here. So finally, what I wanted to tell you, so we've looked at how you set up central banks, and it'll be the same for the BOE, the same design, looking at the UK gilt market as well as the FTSE 100, almost exactly the same template, except you substituted for the UK assets. So instead of having the 10-year note, you have the gilt market, and you have the short sterling market. You have the FTSE, but then you can still have gold and oil, which are more globally denominated commodity markets. Now, for geopolitical events, so we won't look at a workspace, but I'll describe it over here on this side. Excuse me. So, if there is a theme that's running rich in the market, and for example, you trade. Your market that you trade is the Bund, and we're having a housing crisis in the USA, the financial crisis. So what you want to make sure is, if that's your core market, you want to make sure you have the S&P 500 right near there, perhaps the Dow Jones, the mini Dow Jones. You want to have the Japanese yen to see the risk theme. So you've got the Japanese yen over here, you've got the S&P 500 and you potentially have a commodities market, and then you also have the treasury market. So the housing crisis is happening in the USA, so therefore the most sensitive assets are going to be the American market. So you will have, for example, the treasury market over here, and as news breaks out or the markets are being affected, these ones will be affected first, and as a result, you're trading on the back of the markets that are most sensitive or most correlated to the geopolitical theme that's going through the markets. Now, if during the European crisis, the markets that were being affected the most were the peripheral bonds, the Greek bonds, the Italian bonds, the Irish bonds, the Portuguese bonds, but on the ladder, on the futures market, we have the Italian bonds. So next to the bond, you'll actually have your what's called the BTP ladder, which is the 10-year Italian paper, and so that's going to be very close. You're also going to have the euro-dollar currency, because that's so important as the European crisis was unraveling. So as certain events do occur in the marketplace, and as certain geopolitical events are really moving the market, make sure you adjust your workspace accordingly so you gain the most information as close to your core market. So this is where you do the adjustment. When there's no theme running through the market, then you just have your normal your normal workspace. So always remember, always make sure that if there are big political themes or geopolitical events that are moving global asset classes, to adjust your workspace accordingly. So as the Greek crisis or the Japanese tsunami, when the Japanese tsunami was happening, you wanted to have your yen incredibly close to the bund, because that was the market that was affecting global assets around the world. So this is a brief introduction to how to set up your workspace, and with the objective to gain the maximum information from markets that are going to affect your market, that your market is highly sensitive to, and also understand of how to trade correlated strategies. That's something that we talk about in the other programs and our other training courses. But when you can see a correlated market moving, you can potentially see an absorption pattern on your ladder as the correlation breakdown. So thanks very much, and I'm really glad that you have now done this part of the video, and we will be asking questions.
I've executed on the price ladder since ever since I started trading. The main advantage is probably speed and also simplicity. It's a very easy tool to execute on. Main pattern is I look for rigidity in probably the bid and offer, so there'll be reloading, just to ensure that I do know there is some strength in the buying or the selling. That's the main pattern that I'll use the price ladder for. The ability comes from just hours in front of the screen, really, and getting that intuitive feel. I don't think there's any hard and fast rule to becoming an order flow trader, but apart from just putting in the hours and observing. I think I can get a feel for the conditions from watching the ladder. I can feel generally when there's some momentum in the market, or if the market's very slow and quiet and it's more dominated by algorithms, market making type price action. I wouldn't say the price ladder is the only tool I use, but to become proficient and competent in the price ladder, it probably took me a good couple of years of intense, watching it for day in, day out. The toughest part is probably dealing with the setbacks. As a young trader, you can get momentum quite quickly and quite early, but then dealing with the ongoing setbacks is probably the hardest part. For me, it's very variable. If it's quiet, then I can sometimes look to scalp the market, in which I'll be in a trade for 30 seconds to a couple of minutes maybe, or if I'm looking more for a positional momentum type trade, I could be in a trade for a couple of hours. So the longer term trades aren't affected as much by the noise in the price action, whereas a shorter term trade, if you're just looking for 2, 3, 4 ticks, as soon as you see I guess the momentum in the short term shift against you, then that's probably time to exit. I do add to my positions. Generally they're on technical plays, and I try to add them around sort of inflection points on the technical pattern. So I'll be utilising support resistance, sort of areas of inflection, where I can get an asymmetric risk reward on all my on all the extra ads that I am doing. I think I can still trade the short term. I think when it's quiet midday, I think you don't really utilise charts that much if you're looking to scalp the market. But longer term, it would be very difficult without the charts. As I think the price action and the price data is really a tool to give you conviction in what you're seeing in the charts. Good habit to performing well with order flow and understanding order flow, I think, one is being at your desk and having a good level of focus and getting rid of distractions. And the other would be the deliberate practice, so recording your screen and also talking to other people about it, getting other people's opinions. But ultimately it's a very personal skill. I think everyone reads the order flow differently. With the algos, I believe that it actually increases our edge to a certain extent. I think not all algos are proficient and are always profitable in doing the right thing. So they can create opportunities for the intraday trader, I think, for mispricing and certain order entry patterns that these algos do that can become readable. So I do think the algos haven't taken away the edge of the discretionary trader. Well, I wouldn't think I've gotten too much older, but I haven't noticed it really. I think as I've gotten a little bit older, to be honest, I've probably had better focus, being able to stay in tune with the market throughout the day without dropping my focus. So. The advice I'd give would just be to stick at it. It's always changing and you're always adapting to new order flow patterns, and I think constantly staying adaptable, but working hard and making sure that you're spending time on your order flow and your execution techniques, not just on chart patterns or risk management and things like that, but to actually deliberately practice your order flow techniques. The parts of my routine that help me psychologically manage myself throughout a day are probably just the structure of when I'm focused and watching the market, and then times where I take a break, because I think it's important to get away from the desk throughout the day just to reset. And I have my routine set that I'm at my desk and focused for the core hours of the day. Then when it quietens up, then I can take a break, get some lunch, get some water, just to refresh myself and refocus. My trading edge is always evolving. I've only been trading now for about 5 years, but already in those 5 years my edge has completely changed. I'm executing completely differently to what I was a year ago, 2 years ago. So I'm always updating new patterns, new skills, new order flow techniques. But yeah, it's always adapting to the changing environment. No, I take into account the longer time frame analysis. I think the order flow over days, weeks can give you a lot of information, and I think put into a broader context, you can sort of see shifts in the market dynamics. I think firstly from changes in the personality of the price action, and I think that's a huge edge that we do have as an individual discretionary traders, and I think being able to change your approach quite quickly when you do see the changes in conditions in the order flow. My biggest struggle is when it goes really quiet and it's kind of dominated by market making sort of price patterns, and I find that myself personally is quite random and quite hard to read, and also around roll as well can be very very volatile and quite random in how orders are executed. So they're probably two most difficult times I find in trying to read the order flow. Well, it's a tough one, but I think based on the intraday conditions, sometimes if it's very quiet and you've noticed a lot of bids and offers being pulled, there's not much really going through the market on a volume perspective, and then all of a sudden these big orders start coming up, a lot of the time that's when you'll be more prone to think that they're fake, as opposed to if the market's got a lot of volume and it's quite volatile. Then if bigger orders are chasing the market, then quite often more likely to be a real order. But yeah, I think basically understanding the differences in conditions and what conditions produce more fake orders and what conditions produce real orders. I probably use the price action more as a bias and a feel for the day. I'm not too specific in my edge on the price ladder, but I generally use it to tie in with my technical bias.
I've been doing trading for 2 years live now. I had a period on the simulator before, but I had a full 2 years live now. I would say that on the ladder versus just having a simple chart, you feel more the participants. You see. On the charts, you can't see who wants to buy, who wants to sell. On the ladder, you can't hide yourself. If you want to buy, you have to put your order on the ladder. So automatically, you see it, and I feel like it's easier to take the temperature of the market. So I have a couple patterns that I like to trade on the ladder. For example, when I see a very quick acceleration of the price, sometimes it's just one participant who needs to execute a trade, and I like to try to go against and to try to steal 1 or 2 ticks in the other side of the market. Otherwise, with the ladder, sometimes I try to front run the big orders when there is someone, for example, on a round number who wants to sell, let's say, 2,000 bund at certain price, I try to front run this price and to get couple ticks from this. I think to develop your abilities, especially at the beginning, you need to spend a lot of hours in front of the ladders. At the beginning, it seems a little bit like a foreign language. So many times you don't understand what's going on, but after practice, it just gets more and more obvious. And I think at the beginning what's important is to take notes of your observations, to see what works, what doesn't work on the market, and then you need to evolve with the market, because you can see certain habits that take the market for a couple of weeks and then it's gone, and you have another kind of another type of market playing. So it's good to have a good memory of what happened in the past and try to adapt your technique to the current condition of the market. I don't have a special edge. There's not something particular that I execute every day. I try to do a little bit everything. So sometimes it can be just scalping in an area if I expect the market to be quiet, or sometimes if I see, for example, sometimes you can see people reloading the same price again and again. So you can try to go in a direction, and you can see this in the price ladder. When for example, someone try to sell 40, and you have always the guy who reload the bid at 40. So you can try to get long on this, and you expect the market to go up when the people are done selling at this price. Then most of the time they have to pay in the other side, and you get the move after. When you have a compression of the market, sometimes in a very tiny area, you can feel it in the ladder, and as soon as we get out of this area, then when we break, you have the release of the energy of the market. It takes a while to become profitable. At first, when I started in my previous company, we had a training of 3 months, then another period on the simulator, and I would say that after another 3 months on the simulator, I started to be profitable. So I would say it takes about 6 months to become profitable, and then you need I think a little bit more to start to increase your size and to cover your costs, and automatically to make to have your account going up. I think there is a lot of tough parts to become profitable and successful trader. I think you need to like competition, and at least to not be to not give up at the first barriers, because it's very complicated. Even after when you start being profitable, many times you will have a good trend, having many days profitable, and suddenly you can have just one bad event that kills couple days of work sometimes in couple seconds. So sometimes it's tough to go home after such bad days, but you know it's part of the game, and you have to forget this for the next day and take every day as a new challenge. It can be very different depending what I'm doing. If I'm just scalping, maybe I will hold the trade for between 1 second and 3 minutes. Then if I'm positioning, it can take between 5 minutes if I have the perfect timing and everything goes right. Or sometimes it can take 30 minutes, 1 hour, 2 hours. Really depends the kind of day and the kind of trade. For example, if you have a long position and suddenly you see someone who smashed the price in the other side, that can take me out of the trade, or at least I will cut some of my position. I try to not cut my entire position at once. And you look at the market, most of the time you want to take the same position back. So it's better to cut, and then you have you're more comfortable to adjust the trade. I never had to my position. I average often, but I never had, because I hate to see my price getting worse and worse, and then as soon as the market pull back, you have big size and it's very difficult to manage your trade. So I know some people are adding and can have amazing trades, but for me, it doesn't suit my technique. I already tried without charts, because sometimes the chart system just didn't work for 1 day or 2. And yeah, you can survive. You have to adapt your strategy. I feel like it's a little bit more difficult to position without charts, because sometimes you're a little bit lost on the long term. But it's very good to scalp, and I know some people that don't even use charts and just scalp or use the flipper in the market. But me, without charts, I prefer only to take couple ticks in a certain area when you feel the market. I think a very good habit is to, especially at the beginning of your career, is to write the pattern you recognize on the market. And then you need to remember the things when it comes back, because sometimes you can have a certain action on the price ladder and that might be gone for 6 months, and suddenly when it comes back, if you can quickly remember what happened last time and execute the trade, that can be very profitable. So number one habit, I would say observation, and also taking trades, even if it's with two lots, or because so many traders are just watching, and I think when you watch, you don't really learn. It's better to click, and then maybe you're gonna lose, sometimes you're gonna win, but at least you learn, because you feel the pain, you feel the joy, and then you can progress. Yeah, definitely we can see a lot of algorithm on the market. I don't know if there is more today than 2 years ago. To be honest, it's kind of the same, I think. There is a massive difference probably if you were trading 10 years ago. And it changed a little bit your trading, but sometimes you can feel when the orders are with the experience, you can feel a little bit when the orders are fake or when it's a real size that goes through the market. That's why it's important to have the ladder, because you can also see what goes through the market and what is just fake. And yeah, it's something you can't see when you just have the order book and when you don't see the ladder. First, I'm not that old, and second, I would say it really depends your technique. I tend to spend a lot of time in front of the screen because I'm very active on the market. I'm almost always in position. Even if it's just 1 or 2 lots, I've always something on the market. So yeah, sometimes it's difficult to, when you close the computer at the end of the day, sometimes your eyes are dead and you feel very tired, but after, when you have a little bit of experience, you know yourself better, and there's some afternoon when you feel that you're very tired, you know that you're gonna be less rational and it's not the time to take risks. So then you adapt your strategy. Either you're gonna go with a small size, or you're just gonna go home. Sometimes it's the best to do. And it's the same for taking breaks during the day. It's very important to get out, to take fresh air. But it's only it's just an habit that you take when you're trading. It comes naturally to every trader. As I said previously, I think to take a lot of notes of your observation at the beginning and try to see simply what works and what doesn't work on the market. It can be different for every trader. I know you can have a better trader that give you exactly strategy and it doesn't work for you. So it's very about finding your strategy to be efficient and to make money consistently. I don't focus at all on my psychological aspects. Of course, there is some days you feel better than others, but I have really nothing on my routine that help me to manage my emotion or I think it's like in any field. It can be like an athlete or someone who works in another industry. If you have good sleep and I would say kind of healthy life outside, it's probably easier to trade than if you arrive to the office at 7 and you're already completely tired, then it's probably more difficult to trade. But otherwise, I think I'm quite rational even when it goes very wrong. But you only discover that when you have your first very bad trade. And then it's important to stay rational whatever happens, because so many times sometimes you lose just a little bit and it can be a massive disaster, and then you get out of the office and you see this loss completely differently. So of course your emotions are changing a lot when you trade, but it's part of the game. Okay, next. Is your trading edge always evolving, or do you stick to a more strict set of techniques? I think the base of my trading, it's mostly stay the same, but then of course according the conditions, according the events, you have to adapt your strategy to the market, because otherwise if you have something that works in only special conditions, then there is so many times the market change, and if you have 10 losing days in a row, that's a disaster for your account. So you have to change with the market almost I wouldn't say every day, but every week, every month. When you have something For example, if you have oil that move the market, then you have to have an eye on that. Or sometimes you will have, it's going to be the summer, so you'll have less liquidity. It makes the market a little bit different. You have to change your technique. Or sometimes we also have special events in the market, like the last day of the month. So it's always a changing game, and you have to evolve to stay in the game and to take the most benefits. Yeah, I try to do a mix of every information we have. So that can be charts, profile, what I see on the ladder, and I would say that my trade would become with an analysis of the charts, profile, and the fundamental, and then the ladder will be more for the execution to try to get the best price I can. And sometimes I also have specific trades that I execute only because of the ladder, as I said, if there's a big order or stuff like that. Yes, I struggle with flippers, so I just don't touch it at all. But I know during lunchtime, some people are specialized, or during quiet periods, some people are specialized to play with the flippers, and I have absolutely no idea how it works. So I just when I see stuff like that, I just stay out. Yeah, there is no way to find out as long as it's not as we don't touch this price. But for me, with the experience, I would say that most of the big orders that are away from the market, like far away from the market, they tend to be real, especially on round numbers or on special levels. And for example, at the opposite, if you have a big order that comes in a quiet period without any reason, at only 2 ticks from the current price, it's probably a fake order. So I won't front run stuff like that. I only front run big orders when they are away from the market and you see it. For example, at the open, 10 ticks away from the market, then I will start to put orders to be filled next in the queue when the price goes there. Yes, I focus more on the general rhythm of the price action, especially when I need to position for a big move. And then I would say I would be focused on the precise time when I take very short scalp. For example, as I said, if the market goes 5 ticks in 10 seconds without any reason, then I will go against just to take a tick or two.
Advanced order and execution types. Now, we're not here to focus on all the very sophisticated type of order types that you can get in the marketplace, but for any of you people that really want to understand almost the algorithmic nature of orders, then you're more than welcome to go have a look and look at the TT Algo Design Lab, and that really describes various different types of order execution types given certain what-if scenarios. For example, if the market crosses over this moving average, you order you enter X amount of lots into the markets, and there are various other ways, of all different types of indicators and oscillators, but we're really focusing on order flow patterns throughout this course and how to execute it from a discretionary approach. But you can have a look. There is a link over here of all the different types of order types. We focus on some key ones that we observe in the marketplace on a daily basis. But the reason why I wanted you just to briefly look over this, it really makes you understand of why you get all these different types of so-called funky orders in the market. And the more you get these funky orders and different types, when a price reloads, which we talk about absorption later in the module, or when orders go in at a certain speed, at a certain time, at a certain amount, you'll understand it when you read through the link later on this slide. But again, just to let you know that a powerful platform is one that is linked directly to the exchange, has servers at the exchange, and ensuring that wherever you connected from with your price ladder platform, that the IP address goes directly to the exchange. You don't want to go through an intermediary, because then you're missing out on the speed, and when you miss out on the speed, you miss out on the best price. When you miss out on the best price, it's costing you a lot of money. And that's why we do ensure that we use, within our Traders Axia Futures, we exclusively use, we use two main platforms, but the one exclusively used from all our traders is the Trading Technologies platform. So just click on the link, and when you see the link, just make sure you can go through all those order types, and again, go and experiment on your platform, just so you understand all the different methods, because there might be one that really attracts you and makes you understand how what your order execution really is. So, as I've mentioned, just go through the main ones, and once you've done that, then I want you to go on to the next slide when we talk about the lingo in the marketplace. Okay, price ladder and trading lingo. Now, you'll hear through our live stream when we do our weekly streaming directly on the trading floor, and you're watching our traders, in the action, speaking. You'll sometimes hear some explicit words, but it is a trading floor and emotions run high, especially when the markets are moving around, and you'll hear traders speaking about a whole bunch of different words that potentially you've never heard of before. And so for you to really take a learning of what the traders are looking at in the heat of the moment, what they're looking at on the price ladder, how they are effectively seeing the movement into the market. It's really important for you as we go throughout this course, understanding the different types of language and the lingo that we really speak about. So whenever someone says sell or buy at market, that effectively means that you're executing at market. So the moment you want to sell and buy at market, it means you want to get whatever price the market is that you want to sell at or you want to buy, you're going to execute at market. And we talk about that through our through all of our videos. So if any of you don't really understand any of this lingo now, it'll be made a lot more clearer when we go through actually practical examples later on in all the modules when you look at the various types of order flow setups. Bid or offer me. So for example, a broker, a hedge fund might phone a broker and say, I want you to bid me 500 lots at 65s in the bunds. So it's not going in at market, but there's a specific price that you want on the buy side, so you bid me. Or if you are looking to sell at a specific type or a specific price, the market might not be at that price at the moment, then you can mention to offer me. So there might be other traders on the floor. One trader's system goes down. He might say, can you bid me 600 lots at this price, or offer me 500 lots at that price? And again, we'll speak about this through our videos. When we say, just been filled or filled, it means that whatever passive order you had in the marketplace. So if you wanted to buy 2 lots at 55s, the moment the market trades down to 55s and it trades out, that's when you effectively filled. And you'll say, some traders, you'll hear them say, I've just been filled at 55 on a specific passive order. When they say, the market's in a range, it just means that the market is oscillating between a certain range and a particular type of time frame. So if any of you have studied chart patterns, you'll understand more or less what that means. Whenever you hear a trader saying, I just puked, it means effectively, so say if he was long at 55s and the market traded down to 50s, and then his exit was at 49s. The market trades at 49s. He exits his trade for that risk that he had. A lot of traders say, "I've just puked." And a lot of times that term is used when you've effectively paid a bad price, and the market maybe rebounds after it. So that effectively means that when you're puking, you're selling out at market after being long in the market. When you say pay the high, so if you were selling, if you were shorting the market and you were short at 50 and the market trades up to 55, so you now running a loss on your trade, and you exit the trade, and then the market, as soon as you exit the trade, the market comes back towards your price. A lot of traders say, I paid the high, or I paid the absolute high, meaning that you got out at a price just before the market actually turned in your favor. Then there is stacking the bid or the offer. So if you're stacking the bid, what you're effectively doing is you're loading up all your prices. So, you know, on 55, 56, 57, 58, 59, and the market's trading at 60, you've effectively stacked the bid with a whole bunch of buy-side orders. And the converse is true when you've stacked the offer, where the market's trading 60, but you're offering 61, 62, 63, 64, 65, 66, and you offering the market, and that's called stacking the offer. Whenever a trader shouts out what prices are trading, what's the trading price, it's just where the market is trading currently. What price can you get at market? So you can bid 55, offer 56, and this is that is a term that's used, or what is the market actually currently trading at. Then when a trader says the market is bearish, effectively whatever time frame is looking at, that the market is actually coming off. So if you're looking on a very intraday basis, the market sold off 10 ticks, you might say traders say this looks bearish. So bearish means that the market is selling off. Bullish means the converse mean the market is going up, and it's represented by a bull. And as we said earlier, bearish is represented by a bear. So bullish means markets are going up, and bearish means markets are coming down. When the market has just gone a tick up or a tick down, it's just the smallest incremental move for that specific market that you're looking at, however it is priced. So tick up means that the market has moved one tick up in its smallest incremental pricing, and when it's ticked down, that is also the opposite is true. When the market ticks down one tick, the market has sold one tick in its smallest possible pricing increments. Accumulation versus distribution zone. So if you notice a buyer between 50 and 54, so every time the market comes down to 50 to 54, someone steps in and buys every price 50, 51, 52, 53, 54, then that's someone that's accumulating. Accumulation is generally on the buy side. Distribution is on the sell side. So for example, the market, every time it approaches 60 and trades to 65, between 60 and 65, you see a seller come in from 65 to 60 using some particular type of order execution trading strategy type, and he just keeps on reselling that range, whether it be a time slice order or a volume slice order, which we look at in the absorption module area. Then you can execute a certain type of order flow pattern. Once you've spot someone who's accumulating an area or distributing an area, you can get it in small time frames and very large macro time frames. And you could also talk about when someone's sitting on the bid, that effectively means that someone keeps on reloading a buy. So the market trades towards 60, so trades from 63, 62, 61 to 60. The moment it gets to 60, there's a 500 lot. That 500 lot gets taken, another 500 lot reappears, and then it gets taken, and another 500 lot reappears at 60. That means someone is sitting on the bid. Another term for that is reloading, reloading the bid, and then you can get the converse that is true is sitting on the offer, where someone just reloads or keeps on stacking that particular price every time the price gets taken. For you, there are a couple of links there of more technical jargon words. I advise you to go through all of those links, review it, so you really start understanding all the different types of words that can be used on a trading floor, when we are doing our streams on our ladder analysis or our technical streams, and more importantly, when you're watching our traders live in action on the trading across all of our trading floors across the world, you'll be able to understand what they're talking about, and it's be a lot more effective in your development and your learning. Okay, now let's just focus finally at the end of this section, once we've gone through all the videos and all the slides, is trading coordination drills. So I want you to open up your trading ladder, and when you open your trading ladder, I want you to execute 300 trades over the period of an entire day. And during that entire session, I want you to, again, we've done this before, but I want you to be able to trade and execute in multiple different markets at different times. Bring up 10 different ladders and put on all the various different types of order types and really experiment. The more you experiment, the more you start understanding the ways of execution and the ways of playing. Then after that, something just a little bit exciting, I want you to click on that link, and I want you to go and play various types of coordination games. There's a whole selection of different types of coordination drills. I want you to select the ones where you're having to execute with your mouse very quickly. There are a couple of games in there, the moment, like target-driven games, in order to increase your coordination or your speed. So whenever you observe a particular type of pattern in the market, you're able to execute with your mouse very quickly. So that's what these coordination drills are really aimed towards, is your ability to develop your awareness and develop your eye coordination to pick up patterns and execute various different random patterns that just occur. So please just experiment as much as possible, and that's what the purpose of Module 2 is, to really get yourself familiar with the price ladder and increasing your ability to execute with the mouse very quickly. So good luck.